I'm Chang. I run research services for Marcus Millichap, and I am looking forward to sharing with you some of my thoughts on what's going on in the marketplace and some things that I anticipate happening over the course of the next few years. We've had a lot of changes. We've gone through some challenges. We've come out of that. We've seen some interest rate changes. And looking forward into 2025, I think it's going to be a very interesting year. I think there's a lot of positives, and there are going to be some headwinds. And I'm going to share with you my thoughts on where we see things going. You know, Chairman Powell, he has a tough job, right? I mean, you look at them in 2016, there he is, bright-eyed, bushy-tailed, ready to take on the world. And, you know, lately he's had, look, the last 8 years have not been kind to me, but that's a tough job, okay? So we need to remember just what he's trying to take on and how much of a challenge it is to balance the pieces that he's dealing with. And so, thinking about this, balancing the economy, balancing interest rates, balancing inflation, and it reminds me of this time I was flying into Seattle, and it was really a stormy night. The plane's rocking, we're bouncing around, we're coming in for a landing. It was just rough. You know, the pilot's looking out the window as the ground's going back and forth, and he's having a hard time. He's getting concerned, sweating a little bit. And this is what I imagine Chairman Powell's day is like any given day. So it's really just a challenging job. And of course, you say, surely you can't be serious. I say, I am serious, and stop calling me Shirley. There we go. Anybody who doesn't get that joke, you need to watch more movies. Anyway, so he's got a tough job, but at the end of the day, as we look forward, our economic growth is still positive. We have about 2.7% forecast growth for this year. If you look back just a year ago, we were planning on having a recession. We had 1% forecast economic growth. People were very concerned. Right now, it's turning out far better than we expected. And when you look at the forecast for 2025, it remains positive. It's at about 2.1% right now. That's going to change. That's based on the blue chip economists, and it's from last month. So that's prior to the election when that poll was taken. So a lot of economists are going to recalibrate. We're going to see that number move around a little bit depending on what happens with policies as we go forward. But nonetheless, we still anticipate economic growth going into 2025, and it may accelerate. So if you look at some of the key ingredients here, consumer sentiment has been down a lot, right, ever since 2019. That is a key indicator of apartment demand. When people's sentiment rises, we know that absorption increases. And we've seen some momentum over the course of the last year, but it's coming off of a very low period. And in 2022, you saw vacancy rates rise, you saw absorption fall as sentiment fell. And that was a real indicator of the inflation impact on society. Now, I'm expecting sentiment to begin to rise, and I expect it to start to push a little bit higher. When you look at what's happening with retail sales, it's strong, very strong, but it's flattened out. This is by design from the Fed. They wanted to slow down consumption in order to get inflation under control. And when you look at wage growth, it's still 4.5%, which is outpacing inflation. So wages are going pretty well. Spending is still going well, and if we see a lift in sentiment, we should see better performance from the economy. You look at the total household debt. This is a number that gets thrown around in the media a lot. It is very high, but when you inflation adjust that, and especially when you balance it out for income, the rise in income, it actually flattens a great deal. You can see that expenses as household debt payments as a portion of income are right in alignment with where they were before the pandemic. They're about 11.5%. That is really right on target with the historic norm. So when people talk about debt and the risks that are associated with it, they're looking at the current numbers, the nominal numbers in today's world, but they're not looking at it on an inflation-adjusted basis. They're not looking at it relative to income levels, and when you do that, it balances it right out. And remember, the savings level, when you include money market funds, are actually up tremendously compared to 2019 on an inflation-adjusted basis, up by $4.3 trillion. So people's incomes have been rising, savings have been rising, momentum is strong, but confidence was lacking, and that was restraining a lot of the economic growth. That was restraining a lot of the apartment demand in the US. And so if you fix that last piece, we should see a lot more absorption going forward. You look at job creation, it's going very well because the Fed was trying to bring job creation down. They wanted to slow it down. That was one of the triggers. We had wage inflation that was just too high, and we had to bring the employment growth down, and that was accomplished. We've seen some really bumpy numbers. September, 250,000 jobs created in September, which was an anomaly. Then October, because of the natural disasters and the Boeing strike, that came in at 12,000. That's a throwaway number. You can't really use it. So we'll see a lot of those jobs come back in the next reading. So you have to just kind of bear with it and take a kind of a trailing 3-month average perspective. When you look at the unemployment rate, it's 4.1%. That's a solid number. It's effectively full employment. That's right on target with where the Fed was aiming. And the labor shortage has been brought in a great deal. That was one of the greatest challenges that we had over the last several years. If you go back to June of 2022, the labor shortage was over 6 million more jobs than people looking for work. So we had a labor shortage that was really impacting construction. It was impacting personnel for management and operations, and that was impacting the entire industry, in fact, the entire economy. And that has abated. We're almost back to an equilibrium. Historically speaking, we should not have more job openings than people looking for work. That is an abnormal situation, actually. So bringing that back into alignment is a key positive. And that is something I'm going to revisit in a little bit towards the end of the presentation, because I think that's going to be a headwind as we go forward. Now, as I mentioned, Chairman Powell has a tough job, but he feels confident that the inflation rate is coming down into alignment with what he wants to see, and he's focusing more on the employment market to make sure that that doesn't dip too low. We can see inflation trends are in a positive track. We've seen CPI dropping down into the low 2% range. We see core PCE, which is the key ingredient, the key metric for inflation that Chairman Powell and the Fed uses, is at about 2.7%. Still a little bit high. It's been range bound. It's been stuck around 2.7. But the thing is the leading indicators are suggesting that inflation is on its way down. So that mission is largely accomplished. That's allowing the Fed to begin reducing rates. We saw their rate reduction in September, 50 basis points, followed by another 25 in November. But as we look forward, we've seen the 10-year Treasury jump up over the last couple months, about 70 basis points since the beginning of October. And when you look at the forward-looking metrics, FedWatch, the outlook for rate reductions has diminished greatly. So a month and a half ago, I was looking at this, and it was about a 95% probability that the overnight rate would be below 3.5% by June of next year. It was pretty much a deadlock. And now it's down to about 40% probability that it will fall under that level. So the likelihood of rate reductions has been diminished, and that was a direct reflection of the election and how the policy changes that people expect to see are going to affect inflation and interest rates and confidence and growth. So it's a real policy shift that is going to change all of the math in 2025. And it really made my world much more complicated. It changed everything overnight. And so now I'm looking forward and trying to figure out, okay, how do all of these changes affect multifamily? How do they affect the apartment market? And I think we're going to see some positives, and we're going to see some challenges as investors. One of the other things that we need to focus in on is demographics. They are still very positive. We still see that millennial generation, okay, By now, normally, historically, we would see people buying houses and moving out of apartments. That isn't happening with the millennial generation the same way it has in past generations. The median age at which people buy their first home today is 38. Okay, and in the 1980s, it was 24 or 28 when people were buying their first home. The median age of marriage has been pushed back. All of these changes are reshaping housing demand in our country. And so people are staying in apartments for longer. They are not purchasing a home, and there's a variety of reasons for that. One of the key is that just simply the cost of homes, and I'll point that out in a minute. The other thing is that young people are living with family longer. We see this rant all the time about, the 20-something-year-old son who's living in the garage or the basement and play video games. It is the guys. The women have already moved out. In fact, the education level of women is higher. The propensity to move out on their own is higher. It's the boys. They're all stuck down there playing video games or whatever they're doing. But nonetheless, we have this influx up there. As consumer sentiment rises, we'll unlock some of those household formations. We'll see more of those people moving out on their own, getting their own place, and getting an apartment and starting their careers, hopefully. At least hopefully for my son. It's a funny story there, but not now. So you look at the available inventory of single-family homes, and it's really diminished. And that's a lock-in effect. That's the baby boomers choosing to stay in their home all the way to the bitter end. You look at the pricing index, and the pricing of homes has gone through the roof. You look at wages in relation to inflation, and you can see wages have outpaced inflation for years. So that has been a positive trend, but it's not keeping up with home prices. And when you look at the gap between the average rent and the payment on a median-priced home, it has spread dramatically. Now, in this graph, it's 1188, but that was at the end of the third quarter, okay? So we're using quarterly data there. Since then, interest rates have gone up significantly, and that spread is widening out even more. So the loss of tenants going into single-family homeownership is diminished greatly, and when you do the math, only about 27% of U.S. households can qualify for a Freddie Mac loan using the front and back ratios based on income relative to house payments. It's a very small margin. Normally about 50% of U.S. households can afford to buy a home, can qualify for a mortgage, and that's down dramatically. That's going to continue to restrain home ownership. It's going to continue to keep a lot more tenants in the apartments a lot longer. So long term, and this is going to extend more than likely well through 25, 26, 27, because this is not an easy fix. It is a supply shortage that we are facing that is not going to be addressed quickly. When you look at that spread between a house payment on a median-priced home and the average rent in the local market, the Bay Area is astronomical. It's almost $10,000 a month difference in that affordability gap. And you work your way down through basically the West Coast. It's Seattle and San Diego, and then you get some up in the Northeast, Manhattan and Boston. So that spread is dramatically wide. If you switch it and look at the markets where the barrier is lowest, you get places like Cleveland, St. Louis, Detroit up in the upper Midwest there, Philly, Indy. So those are markets where your propensity to go buy a home is higher relative to your rents. The gap is not as wide, so housing affordability is less of an issue in those areas. But that gap is still pretty wide. So it is still a barrier to entry into home ownership. Now, shifting gears, I want to talk a little bit about the multifamily outlook and what we see happening there. We've seen the pace of construction has been a major challenge, right? So this year, we're going to add about 520,000 new units to inventory across the U.S. That is a record high, going all the way back to the 1980s. Last time we hit numbers like this was the 80s and early 90s when the baby boomers we're starting to move out and form households. So the housing market actually adjusts, and as you go through these demographic bubbles, housing completions will accelerate in order to compensate for that demand, but it is not in lockstep, it's not in unison, so there's still some challenges there. We are seeing it tip over. We're starting to see absorption pick up and balance out against that inventory addition, and in 2025, we expect the pace of construction to slow down. Still high, but slow down, and that is the tipping point where our absorption is starting to accelerate and our pace of construction is starting to slow down. So that is going to be a positive. When you look around the country, the concentration of housing units going into markets like Dallas and Austin and all across Texas, Florida, Phoenix is very high. That's elevated. And this is over the last 5 years. Dallas area has added about 155,000 units. And if you do the math, that's almost as many new units as were added in all of California in the same time. And that's why affordability in California is so poor, and why affordability in Dallas is actually quite good. And that's why you start to see this balance in that market, because they're adding enough housing to meet the demand, even though Texas is adding so many jobs and so many people. You look at in Austin, for example, our company was working on some efforts to restrain rent control. And we pointed to Austin and said, look, Austin develops so many units, it outpaced demand, and you see rent fall. Supply and demand works. Rent control doesn't. And so we're a strong advocate of development instead of rent control policies. So I think a lot of those may abate, but I was talking to Sharon Wilson-Janot from NMHC, and she was talking about it's going to move from a national issue to a much more local issue with the change of administration. So that's something everybody in this room needs to pay attention to on a local level. Rent control is a real challenge, and it can really cause problems, not just for us as investors, but for the market as a whole, the balance and equilibrium for housing. So that's going to be a challenge going forward. Now, the pace of construction is slowing down significantly. The cost of labor, the cost of materials, and just in terms of the overload of housing stock going into certain markets around the country, Texas, Phoenix, and a few others, Charlotte, Nashville. And so we're seeing that pace of construction slow way down. The number of apartments under construction currently down by about 30% compared to historical. When you look at the number of starts, it's down about almost 80%. So we see the end of this wave coming. And as we look forward, that supply-demand balance moves back into alignment, even in the markets where you've seen the most construction. If you look at the absorption relative to construction, and I'm using a trailing 12 here because there is seasonality to this. You can't just take it on a quarter-by-quarter basis because it jumps around a lot. But we're almost back into alignment. We see that pace of absorption moving back into alignment with the pace of construction. And again, as we look into 2025, we expect that construction pace to curb over, and I expect the absorption pace to accelerate. And so we tip over. In fact, we've already hit it on a quarterly data point. In the third quarter, we built 163,000 units in the third quarter this year. That is a record high. I've never seen a quarter that high of data going back to the late 90s, okay? That is the most new units added in a single quarter. But our absorption in the third quarter was 191,000. Again, a record high. Actually, it's not quite a record high. It actually was better in 21 when we came out of the pandemic. But it is an exceptionally high number for a single quarter, and it outpaced the construction level, and that is a sign of where the market's going from a supply and demand market. When you look at the different metros across the country, I mentioned Austin. I find it fascinating because Austin added 9% inventory growth over the last year. It had 7.3% absorption, which is huge. Everybody should be cheering, but we had so much construction, it still fell short. You see that in Nashville, Jacksonville, Charlotte, Salt Lake City, pretty much every market across the country. The pace of construction was outpacing the absorption levels, and so we've seen those vacancies ride up a little bit. But again, as I look forward, that pace of construction slows down and the absorption gains momentum. Looking at the vacancy forecast, we just came up with these. You know what, I'm going to take questions at the very end if you don't mind. When you look at our forecast for vacancies across the U.S. For 2025, these are preliminary. I'm still tinkering with this. I haven't gone official with them yet, but you get an early look here. We're expecting San Antonio vacancy coming down, Southeast Florida vacancy coming down, Minneapolis, Salt Lake City, and so we see some downward pressure. It's not a lot. We still see some upward pressure in some of the overdevelopment markets. Places like Charlotte are still seeing a little upward pressure on their vacancy rates, but we're moving back into equilibrium. We're starting to see that momentum shift, and we're going into a balance. I may push the absorption numbers up a little bit higher in my forecast as I look at this at the very end of the year before we release our 2025 investment outlook at NMHC this year. But we're jiggering with it, we're fine tuning. And so I expect that the momentum will be sustained and maybe slightly better than what we're expecting right now. In terms of rent growth, we are seeing that shift. Again, we're seeing that momentum grow. Not huge rent growth, but we're seeing an uplift there up to about a 3% rate. That's, again, a positive for our rent growth. You see the strongest rent growth actually in parts of Florida, Philly, what do we got, Chicago. Those are the markets that we're seeing the strongest growth. The overdeveloped markets, the markets that had the most inventory, is where you're seeing the weakness in the rent growth. That's including, you know, Austin, San Jose, Houston, Sacramento, and so on. So the momentum is shifting. The gains are out there, but they're not huge. We're really in the shifting gears standpoint from the supply and demand metrics for multifamily. In terms of investment trends, you know, I don't have to tell you, the transaction velocity down significantly. That has been a real challenge, literally for everybody in the room, most notably, you know, the brokerage companies. But it is starting to shift gears. I do see a momentum shift out there, down about 25% from what I call normal. Right? I can't count 21 and 22 as normal. Those were abnormal years. It shot through the roof. We're about half the levels we were at there. But when you compare it to 2014 to 2019, which I considered normal in the current climate, we're down about 25%. So that momentum is starting to shift. We've seen some green shoots in the transaction velocity over the course of the last couple months. Again, the election could shift gears a little bit, but I think that the gains are there. In terms of pricing, you know, multifamily is on sale right now, right? Down 10 to 20% depending on the market. If you're a buyer, that's good. If you're a seller, not as good. We've seen a lift in the cap rates up a little bit. But again, I think we're moving into a stabilization cycle. Again, a lot's going to depend on what happens with interest rates, and that's going to be a key ingredient. The spread between the 10-year Treasury and the cap rates has come back in. At one point, about 45 days ago, that spread had opened up to about 200 basis points. That was when deals started really picking up some momentum. It has since been squeezed down to 160 basis points again, and we've seen the deal flow start to taper a bit as people look at it and go, man, the deal worked, you know, 2 months ago when I put it under contract, but now I have some challenges with my financing. So, you know, this is a place where a relationship with your lender is a really valuable thing. They can help you through this cycle and try to get these pieces put together and evaluate your options. So that squeeze is there. I don't think that's going to get a lot better through the end of the year. So the challenge is there's uncertainty in the marketplace. People are not sure what policies are coming into place, and so they're not sure what's going to happen with interest rates. Banks pull back a little bit in that cycle, and so they're going to keep those rates up a little bit higher. Now, there are 5 trends that I am watching very carefully. These are going to really shape what happens in 2025. Some of these, I have a good idea where it's going to go. Some of them are up for grabs, but I want to share these with you. The first is labor shortage and wage inflation. Now, this is something I mentioned earlier, but we had a huge labor shortage for a period of time. And as a result, we saw wage growth accelerate to 6, 7, 8, 9%. depending on the sector. If you look historically, 2016, 17, 18, 19, 20, 21, the pace of legal immigration to the United States dropped dramatically. I believe personally that this is tied to anti-immigration rhetoric and a belief that when you're chanting "build a wall," people feel less welcome. And so we had slower immigration over that cycle, and it declined over a period of about 3, 4, or 5 years there. Now, you got to throw out 2020 and 2021. We had a pandemic. Nobody was coming. Nobody was moving anywhere, right? Everybody's locked up in their houses. So you weren't seeing that. That's a complete anomaly. But as I look forward, given the policies that are being discussed today, I believe that we could face reduced immigration to the country. And as a result, the labor shortage could rise. We could see particular impact in construction, in leisure services, restaurants, and a lot of the labor-oriented agriculture has been identified, and that will put upward pressure on wages, and wage inflation is a possibility. So that is one thing that everybody should be paying attention to because that could impact your operating costs, that could impact household formation, and so on. The next one, the interest rate outlook. Now, you have a couple challenges here. One is inflation and what happens with the Fed and how they address that. The other is we're still going through a quantitative tightening cycle. And so the Fed is reducing their balance sheet. They're not buying as many treasuries as they have in the past. And as a result, that puts upward pressure on long-term rates. If we go into a stronger deficit-based budget, if the deficit starts to rise more quickly, which is something that some people are saying may happen, then the placement of treasuries, the increased treasury issuance, could put upward pressure on interest rates. Okay, I'm not saying that will happen. What I'm saying is that based on what's being talked about today, that is a risk that we need to consider as investors, that we could have upward pressure on interest rates based on tax policy and spending policies. Now, if we have a lot more efficiency created, they bring the budget down and the spending, it all works out and everything goes, that becomes much less of an issue. All right, so we don't know, but it's one thing we want to keep tabs on in 2025. The next is insurance costs. That is a top issue for investors. We're all aware of it. We've seen it happening. You look at how much insurance rates have gone up over the course of the last 5 years, up 155% nationally. You look at a market like San Francisco where they have the highest insurance rates, and they've gone up dramatically there, 228%. You look at the biggest increases, Jacksonville, 358% growth in insurance rates over the last 5 years. Now, at the other end of the spectrum, the smallest increase has been in Cleveland, about 12% growth, and the lowest rates are in Salt Lake City. So it doesn't affect everybody the same. And as we know, a lot of this is a factor of natural disasters and what's been happening, not just hurricanes in Florida and reaching up into the Carolinas. This is wildfires. We have wildfires up in the Northeast. This is creating challenges in California and the Pacific Northwest, all across the nation. The number of natural disasters that we're facing in any given year has gone up dramatically. And we know that the policy of insurance is balancing risk, right? So if I'm getting hit with hurricanes in Florida, I'm going to raise their rates a lot, but everybody else's rates go up too, right? I'm going to displace that risk and spread it across the whole country. And when you look at the number of natural disasters, this is billion-dollar plus, inflation adjusted, billion-dollar plus natural disasters in the United States. Back in the 80s, we were averaging about 3 per year. 90s, 5.5. The 2000s, 6.7, and we've seen a steady increase in the number of natural disasters, big dollar natural disasters across the country, and this is a key ingredient driving up insurance rates. I don't see that trend reversing, okay? So as we think about what's happening with our insurance rates, I do not expect that they're going to get better anytime soon. So this is something, as you're planning your strategies, looking forward, 25, 26, 27, over the next 5 years, your hold periods, you need to factor in, okay, I need to have an insurance strategy, because this is not, I can't rely on the market to come down. I'm gonna have to build this in somewhere else and understand that when I'm underwriting, I'm looking forward into this. Multifamily delinquencies, this is something a lot of people keep asking me about. We're not seeing them. There are some, there's a handful. I've seen syndicators get wiped out, okay? I see the banks looking at this and saying, look, these ones just aren't gonna work, right? And for that handful, they're moving them out to the market. Now, a lot of times they're gonna sell the underlying loan, or they're going to move it to they may take it back and partner with an operating partner. I've seen that with some people. I've seen them go out to investors, particularly in office, where they say, okay, we've done business with you a long time. We got to get rid of this thing. Do you want it? I'll sell it to you cheap just to get it off my books and not take it through a process that gets into the news and media, and so that we can clear this out of our books without creating a lot of noise. And right now, the banking sector, because of the banks that went out of business, okay, they kept talking about the problem with real estate. None of the banks that have gone under have been put out of business because of their real estate portfolio. It was because of massive withdrawals and a run on the bank, because of a lack of confidence in those banks. And it may have been tied to real estate that caused it. That was the trigger, but that is not the underlying cause, right? The underlying cause is a fall in confidence. And the thing is if you're running a bank, you don't want to create a situation where the confidence in your bank drops. And the one way you can do that is start saying, hey, we have a bunch of bad loans on our books, who wants them? And so you're going to see those things come out, but they're going to be on the down low. You're not going to see, banks come out and see big foreclosures. They're going to extend with anybody who's a good client that they know and trust. So I don't see this number going up. This is CMBS, delinquency rates 30 days plus late on payments. That number is nowhere near what we saw during the financial crisis. There will be some. If you can find those deals, fantastic. They're great opportunities, but we're not seeing a wave. We're not seeing an RTC or anything like that. And then my final one is the capital flow right now. Now, one of the things, I was traveling all over the country over the last few weeks talking to a lot of investors, especially institutions. And we are seeing a shift of gears from a lot of the institutions. Their share of the transactions right now is increasing, and we're seeing more deal flow coming from that group. Now, for private investors, for the last couple of years, it's been great. You haven't been dealing with them. You're not competing on assets with them. But now we're starting to see major institutions get back up on their toes and start to look at acquisition opportunities. They're pruning their portfolios, predominantly the office properties, over the last couple of years, and they're freeing up capital and they're starting to reallocate. And one of the property types they're going back into is multifamily. So you're seeing more aggressive growth there. When you look at the dry powder, it's down a little bit from last year, but at the beginning of 2024, the amount of dry powder was about the same as 2023. And we've seen some big deals happening so far this year. We saw some, Blackstone deals, Equity Residential, KKR, a few others coming back into the market. And we're starting to see that capital get freed up. That's going to put more competition on the market for these assets and really rebalance the transactions activity. Now, again, in light of some of the changes, some of the uncertainty we're seeing in the post-election cycle, this may slow down a little bit because institutions in particular don't like uncertainty. They don't like to do something when they don't have a very good idea of what's happening in the future. So right now, there's a little bit of recalibration taking place, but I do see the need to get that capital placed, and I do see that activity level continuing to rise. So, the big question, will we stick the soft landing? And, I saw this, we don't have the audio. Do we have audio for this? It's much better with audio. The guy is just ranting as he's watching this video. He's like, oh no. Anyway, the economy, it's coming in, it's landing, it's bouncy. but everybody's going to be okay. The plane lands, it bounces, and eventually it has to go round again, and then it will come in, and we start to see that soft landing. All right. Yes?
Two questions in one statement. The statement is that the way you're describing it, everything seems to be going in the right direction, and it seems like it has nothing to do with what Biden's done, but rather, actually, in spite of what Biden has done, it seems more as though that it's just the market economy that's kind of bringing it to a, bringing it to a level of stability. Is that correct?
What I would say is there was a lot of uncertainty, okay? When inflation was at a highly elevated level, then people were scared. And when the media was saying, we're going into a recession, everybody get ready, brace for impact, people get scared. Household formation slows down. People say, I'm not going to go out and rent a new apartment. Okay? That is what happens when sentiment drops. So as we got through that, as confidence has built again, as the inflationary pressure, which was driven by a variety of factors, but as inflation has come down and confidence levels have improved, we're seeing better momentum. We're seeing household formation pick up. And, set aside the presidential politics, but the fact is that when people are scared, they're not going to create a household. When they feel better, they will. Now, sentiment, that's why I focused in on sentiment and said, hey, if sentiment rises, because 51% of the people in the country didn't feel good about where we were 6 months ago. As a result, they hold back. Now, 49% is saying it's not that bad, but it's okay. That's not an enthusiastic, yeah, go. That was I don't think it's that bad, but I'm not sure. Now, if you shift gears and you see a real sentiment shift, and we measure that, the University of Michigan Sentiment Index, that is going to be something that I'm going to watch very closely over the next several months and see how that moves, because that has a direct correlation into the demand for multifamily.
The other thing, as far as the labor situation, we find that, yes, we can find labor, but they're not worth anything. They're very expensive, and they can't be trained, and we're having major problems. And our turnover is close to zero. We have long-term people who've been with us for many, many years, but as we acquire new properties, it's very challenging us to find the right quality of person. They just don't seem to be out there unless we steal them.
I meet with the National Association of Home Builders multifamily division, and I talk with them because they're right on the front lines. So these are the biggest developers in the country. One of the challenges they are talking about actively is the loss of talented, skilled labor, especially in the trades. And so a big piece of this is the baby boom generation, okay? These are the people who were raised in the trades and really know what they're doing. They're in their 60s now, and they're planning to retire, or they are already retired. And that's creating a skills gap that everybody in this room is going to face, especially every developer, anybody who needs a maintenance person, and that's driving up that cost of your construction labor, your operations labor. Again, when you have a labor shortage, you're trying to find that one person who is looking for a job. And so the mix of options that you have is limited. Now, I just hired a guy who's like a rock star analyst. I got lucky. I'm excited. I'm sure he was brought in by my reputation. But the thing is that was a 1 in 1,000 for us. I mean, I was so excited. Now, when you talk about your labor challenges, my concern is this doesn't get better looking forward. This is going to be a headwind. Literally, you have good people, take care of them. Honestly, this is going to be a challenge. You're going to want to make sure that you have the best people on your team. Oh, we have a question in the back who has a microphone.
I have a twofold question. If you're following through with the policies, and he's going to clean up the government as far as closing down departments, those people are going to need jobs. If you talk about AI or just technology advancements, and especially with a labor shortage, that's when there's more innovation that comes in. Do you really think those two things, when people are nervous about jobs being lost, shouldn't that counterbalance the level of immigration you're discussing?
Wait, so one of them was AI?
Between AI and efficiency, also if it's actually true, the rhetoric is really going to close down departments and of the government, and there's like...
Oh, closing down departments.
Jobs.
Oh, Okay, I got a lot of cynical answers. Okay, you're gonna create more efficiency in the government, and we're gonna get rid of all these bureaucrats who do nothing. So now, you as a business person say, oh man, look at that fantastic labor pool. Let's go hire them. What's that?
The many great people, and there's some people that are here, I met them before they got into where they are now.
Yeah.
They're working for government or companies that no one tracked them, so they just did their thing.
Sure.
Listen, the world's coming in order for Trump said he means business, so it trickles down. That same worker could produce differently in a different environment.
Okay, it's possible. But we're not talking about the same order of magnitude, right? We're talking about labor shortages in the millions. This is over a period of time. In 2020, we had 6.2 million more jobs than we had people looking for work. So in regards to AI, I was talking to the chief economist for Oxford Economics. He said, AI is amazing. It's going to have an impact. It's still in its infancy. Based on historical cycles, it takes about 10 years for a full adoption and integration. So you're probably, even at an accelerated pace, you're still looking 5 years out before it's making a real dent on productivity sufficient to offset labor shortages. So yes, it will impact. And yes, if we can create efficiency in the government, it will be an impact. What I'm saying is that it probably isn't going to be enough to fully offset the challenges, and that if we do face a labor shortage and it does increase, then we're going to face increased wages, and we're going to find it harder and harder to find people. Now, is this going to happen? I can't, I have a crystal ball, but it's not, it's challenging, right? It's not 100%. These things could offset. We could have a fantastic outlook. As an investor, I look forward and say, what do I see happening? What do I see in the future? And I say, what risks are out there, and how do I mitigate those? So I try to balance that. I prepare for the worst, hope for the best, right? If that's how you build your strategy, it's safe. If you're hoping for the best and preparing for the best, then you have challenges.
How do some of the other Trump policies play in, meaning deportation, deregulation, lower energy costs, tariffs? How is that going to affect all of these models for 2025?
It's a tough question. We don't know. But reduced immigration I've talked about. Deportations exacerbates that issue, okay? So you see increased pressure on the labor market. Tariffs are inherently inflationary. Mathematically, they just are. Now, people talk about offsetting it with a stronger dollar and some of these other things. Yes, that can make a difference, but in order to offset a 10% tariff, your dollar value has to go up 10%, right, or something like that. So it's really challenging. Now, I was just in Dallas last week, and I was talking to a lot of investors there, and a lot of them said, "Look, this is just rhetoric. We don't know how it's going to play out," and that is true. I do not know how those will play out. If we see 60% tariffs placed on China, that's going to have a huge impact. That's going to drive up costs. Five or Less, the discount retailer, their stock plummeted after the election because they get most of their products from China. That is going to have an impact. If we don't get a 60% tariff, if we get a 10% tariff, it's probably not going to be that big of a deal. If we level 10% tariffs across every country in the world, that's going to create some challenges. That's going to create inflation. Right? It will take time for the U.S., the isolationist policy. You build up your U.S. infrastructure and your U.S. manufacturing, your U.S. Product development, and that's going to offset those things. And, that takes time. So you get a staggered impact. If you put punitive tariffs of 25% on Mexico, we're in the process of reshoring manufacturing from Asia to Mexico. If you put 25% tariffs on the country you're looking at reshoring everything into, you're going to create huge, huge problems. Will that happen? I was at another conference last week where there was actually people from the Mexican Trade Commission. They're saying, look, we don't believe that those will happen. we believe that Mexico is in a position where they're going to want to negotiate and come up with a deal. So that one is lower probability.
Good morning, John. I have a threefold question. Number one,
Three parts. All right.
It's the Marcus Millichap way, right?
Okay, let's go.
So number one, you spoke about markets that are not supply constrained and there is a ton of inventory. Let's say Tampa and Austin as an example. When do you think these concessions in these markets will go away and that supply will dwindle?
Okay.
That's number one.
Let's take them one at a time.
Okay.
Number one, will supply and demand rebalance in markets like Tampa and Austin? The answer will depend on that confidence, that sentiment level. That's going to be key. The pace of absorption. I anticipate we will move towards a rebalancing over the course of the next 2 years, depending on which markets we're talking about. There were a lot of them that oversupplied: Charlotte, Nashville, Phoenix, most of Florida, most of Texas. Now, most of those are growth markets, and I still believe that they will move back into equilibrium over the course of the next 18 months, and then we start to see upside because the pace of construction is slowing down in those markets. Next question.
So number two, we saw institutions, we talk about private equity, to be more active. We did not see that in 23 or 24.
So we
I
saw
think 90%, as far as putting out common equity, were completely on the sidelines, and
Yes.
overnight, they all became pref equity providers or credit. And there were two reasons they gave us. One was that the 10-year is too high. They can't really mitigate risk or measure it. They don't want to lose their jobs. And the second was the uncertainty of the election. So we have now rates that have spiked up since Trump got
Yes.
elected, but we have the election behind us. So
what I'm saying is
are they
that
going to come
we're-
back to the market, or we're going to have another year of, well, I don't know, you know?
the momentum is shifting. That's my point. So we saw a $10 billion Blackstone deal. We saw KKR with whatever it was, a $5 billion deal. We're seeing a lot of that momentum. When I was talking to the institutions up in the Northeast, they've sold off a lot of their office assets, and they need to place that capital. They have to get it out the door. And so they're feeling pressure. I know that they're going to be cautious by nature, and these barriers exist, but they are going to want to get that capital out the door. All right, last
Okay,
question.
last part. You touched upon many markets and cap rates and demand, supply, all that stuff. If you had $100 million today in your fund, where would you go? Why? 3 top markets.
I'm going to Vegas, baby. No, $100 million is a good deal. Okay. I live in Phoenix, and I really like Phoenix. I think a lot of the overdeveloped markets in Austin, Florida, Texas, I think a lot of those have good potential. What I'm looking for when I'm investing is something that's changing in the market. Something that's not baked into the pricing today that I see changing over the next 5 to 7 years. That investment cycle, right? So where I can see something turning over the next 5 to 7 years. My exit strategy. I'm trying to keep my eyes on the horizon. I'm trying to focus longer term and say, what's going to be, skate to where the puck's going to be, right? Gretzky. So I look at a Phoenix and I say, okay, do I believe that TSMC is going to hire another 225,000 people over the course of the next 5, 10 years? Yes. I see the plant. I've seen it. I walked it. I know it's coming in. I like that market. Even though the prices are high, even though we've seen a lot of development, the pace of construction is slowing down. I like that story. I look at Austin. Austin, we had this huge wave of development. It overbuilt. It overshot. Right? You have concessions, the market's getting beat up a little bit. But the thing is you look at all the companies that have moved to Austin over the last few years and look at the outlook for those companies, and those are pretty strong companies. And the outlook for those companies is good. Their demand for labor is good. And so you see that momentum shift, and that supply pace of construction slow down, and that momentum shift, you can see an outlook for that market that is positive. The same is true in, say, a Tampa. I love Tampa. It's a great city. It's got some challenges right now. They had a hurricane blow through. But the thing is fundamentally, the local government in Tampa is very progressive and very smart. I like that, and I like what's happening there. So as I'm looking around the country, I'm looking for those things. I like San Antonio. San Antonio, if we see that manufacturing shift into Monterrey, Mexico, that I expect to see. It's going to recalibrate what happens in Laredo and San Antonio and Dallas. That is going to be a major supply chain over the course of the next 10 years that is going to structurally change those markets. Those are the places I'm looking at when I'm looking at investment opportunities, because there's something that's changing that not everybody knows about, that I can forecast because I have better data than anyone. So there you go. I think I'm like 10 minutes over. So with that, thank you, everyone.